Hello, my name is Michelle, and I'm here with Mark Sorensen, the CEO of Royal Fund Management and 401k Maneuver, a firm with about 1.2 billion in assets under management. And today, Mark and I are going to be talking about what's going on in the markets. What do investors need to know? There is a lot to cover and a lot going on. So, Mark, thank you so much for being here.
Oh, you're welcome. Excited to have the conversation.
Yeah. All right. So I want to start out with Fitch's credit rating downgrade of the U.S. debt that just happened. And my first question here is, how does this affect investment decisions moving forward, not just for people like yourself, like Royal Fund Management, 401k Maneuver, but also for individuals?
Great question. I saw that news last night, and I thought, well, actually, I thought Fitch, you're a little bit late. Maybe you're relative now. You're part of the conversation.
Yeah.
But for those that don't remember, the S&P rating company downgraded America's debt. I think it was September of 2011, 12
Right.
years ago. At that time, there was a reaction in the marketplace. I think we went down nearly 20% over a pretty short period of time. But we also recovered very, very quickly. And now, 12 years later, Fitch has decided to do that. Let's kind of put it in perspective. Do you want to put your money in America, or do you want to move it all to Europe or India or China? And I'm kind of being cute here, but America is still the best place to put your money if there's concerns. And so I don't think it matters much. What matters more is not what Fitch said about America's debt rating, taking it from AAA to AA plus.
Sure.
What matters more is what the market thinks about it. And actually, the market today is taking it pretty well. I don't think over time it's going to matter that much to the market.
Good to know. That's one of those things is, the media, we live in a 24/7 media world, and they tend to sensationalize things like this. And the question is it as big of a deal? So I think you answered it. Thank you so much. All right. So I want to move on and talk about the Fed. So they're on a roll with raising interest rates, yet inflation isn't subsiding like they want it to. Do you think that the Fed is going to hit their 2% mandate? And another question, part two, is do you think that they're going to do more harm than good in their quest to reach that 2% mandate?
Well, that's the big question, isn't it, Michelle?
It is.
I would argue, though, that inflation peaked at about 9.1% last June, and now we're down to about around 3%.
Right.
I think going from 3 to 2 is going to be painful. I don't think it's going to be easy. But we have seen a significant drop in inflation pressure. But there's always the concern that the Fed does too much, right?
Right.
And then they harm the economy. So you hear the R word thrown out there all the time, and I mean recession, right? A lot of people think that the Fed's going to do too much, and I think one of the reasons they think that is the Fed has as much said that. They said they think there's more risk in stopping too soon than doing too much.
Right.
A lot of economists and pundits think, though, that we're nearer the end than we are the beginning. The interesting thing is, why is the market doing so well despite higher interest rates? In fact, I believe it's the fastest acceleration of a 5% move up in interest rates in the history of the Fed. I think there's only one or two other times they ever raised 75 basis points at a Fed meeting. They did it, 3 or 4 times in a row. They did pause last month, and then recently raised another quarter. They've even advertised that they think maybe one more time.
Sure.
So the market's a leading indicator. The market looks forward. So the market's already looking past this. It's looking 6, 12, 18 months down the road. It anticipates that the Fed is nearer the end of the tightening cycle than the beginning. A lot of people say, and I guess it's true, that they just started too late. Remember the transitory comment?
Transitory, right.
Inflation's transitory. It'll come right back down. So the Fed got kind of behind the 8 ball, to use a cliche. And so they quickly adjusted path, and now the question is, do they do too much harm in trying to get inflation down to 2%. I think we're headed in that direction. Obviously, from 9 to 3 was pretty quick.
Yeah.
From 3 to 2 might take a little longer. But I think the Fed's going to pause here. And the reason for that is they themselves have indicated that there's such a delay. When they raise interest rates, it takes 4, 6, 9 months, maybe a year, to see how that actually, the impact that actually has on the economy.
Right.
So they've raised rates so fast that I think they even probably recognize, though they might not say that in their press briefings, that it's time to wait and see whether they've
See
gone
how the dust settles. Yeah.
and see
So
kind of how the dust settles.
You mentioned the market's strong. Well, we know the economy and the job market's really strong. What do you think? I mean, I know you don't have a crystal ball, but I want your thoughts on this. What do you think is causing average investors to be so nervous right now? Is it just there is a lot going on?
When you have a bear market like we did in 2022, there's a couple of old sayings that stem from what happens next, and that is the market makes a quick recovery. And one of those is that the market climbs a wall of fear. And yes, people are fearful, but the market keeps going up. And then what, at my age, is it fear of missing out, FOMO, right?
FOMO, yeah.
Then the market keeps going up and people have a fear of missing out. And then the bears have egg on their face, so they slowly have to start changing their mind. And then you get short covering in the market, which causes natural buying and short covering, and it can make the market pretty explosive in short periods of time. And I think that's what we've seen. I think the biggest reason that there's still a lot of uncertainties, inflation. When was the last time we talked about the war in Ukraine?
Yeah.
In fact, that is interesting to make that comment. I can remember, oh my goodness, Greece is going to go bankrupt. Oh my goodness, Cyprus has this problems. Whatever the problems are that people or the market's concerned about, as you said, they sensationalize it in the headlines for a while, and then it just kind of goes away.
And then disappears because they move on to something else, right?
Move on to something else. Well, the fact is this. The market only cares about two things, earnings and interest rates. Interest rates are higher. Earnings have come down.
Yeah.
However, that's what caused us to go down last year at the Fed tightening cycle. But the market finally wakes up and says, okay, wait a second. Now we've got to start pricing in the earnings recovery.
Yeah.
And that's why valuations actually go up when one would think that there's still too much to be concerned about. And the reason price earnings ratios go up during this time is because the market starts to price in the earnings recovery that's coming in 2024. So I think that's the biggest thing, is to remember the economy and the market are two different things.
They are very separate. Yeah.
I've seen times when the economy is doing great and the market's doing bad, and you wonder why.
Yeah.
Or times right now where the economy is doing okay, but the market's doing extraordinarily well year to date. But again, it's because the market's a leading indicator. It's looking past the current uncertainty to a time when it foresees that we're going to have an earnings recovery. Inflation is going to be under control, and in fact, maybe even the Fed actually starts to cut interest rates at some point in time next year.
Okay. All right. So you mentioned earlier the R word, recession. We've heard it for 2 years now. We're going to be in it. We're in it. Where it's coming. It's not coming. Where did it go? And what are your thoughts? Do you think that we've made it past that point where it doesn't look like a recession is going to happen, or do you think we're in one now?
Well, who knows? I think you said earlier there's no crystal ball. However, it's kind of interesting. The market moves not based on expectations.
Right.
The market moves based on a variance from expectations. Well, it's interesting that from an expectation standpoint, this is probably the most well advertised expected recession in my 42 years.
Yeah.
They've been talking about it forever. In fact, leading economic indicators are down something like 15 months in a row. Typically, if leading economic indicators are down over 5%, this far into it, we're already in a recession. historically, and yet we're not. Here's, I think, the reason why. What I've been telling our clients and our advisors for goodness the last 18 months is that we thought there's a reasonable chance there would not be a recession. There will be at some point in time, right? That's
Sure. What goes up comes down.
ebb and flow of the economic cycles. However, the reason I've been saying we may avoid it this time is because when the Fed started raising interest rates and the market started going down, that process started from one of the strongest economies we'd ever seen. So what I was saying is that I think we have enough cushion. I mean, you mentioned the unemployment rate recently and how low, 50, 60, 70-year lows or something like that. The economy was already so strong that, yes, it has slowed, and the hiking interest rates, the Fed, tightening policy has slowed the economy, but it slowed it to slower growth, not to a contraction.
Right.
And I think that's likely to continue. In fact, just recently, there were economists that were raising the expectations for what's called GDP, the gross domestic product of America, which is economic output. Now, that's not to say that the time it takes, as I said, for these higher interest rates to really filter into the economy and cause problems, that we still don't have a recession. But I think any recession is going to be extremely mild, if we have one at all. And I think it's been expected for so long that it probably won't have much market impact. Remember, this is the most advertised expected recession I've ever. They've been talking about it for a year and a half now. Where it's a variance from expectations that causes markets to move. And the market already understands that the economy is slowing down, but we're already August 2nd today. The market's going to be looking into 2024. Usually when you have an earnings recession and corporate earnings have come down, after a couple of quarters of that, the market starts looking forward to the earnings rebound, which may come, in the fourth quarter and into next year.
I have a question on that. How far in advance do markets look? I mean, so we're in third quarter. Third quarter, second quarter right now.
Starting the third quarter.
Thank you.
Yeah, we are in the third quarter.
It's August. I can't believe it. This time has gone by so fast. Wow. So we're in the third quarter. So how far out are they looking? Are they already into Q1 or Q2 of 2024?
Oh yeah, I generally I just say on average 6 to 12 months the market looks way ahead. The market is a leading indicator. The market, I'm talking about it like it's a person, but it's pretty smart.
Sure.
There's an old saying that the market is extremely efficient, and that is true. And the market is a leading indicator, and it's looking forward. Now that said, we've had a huge move since the beginning of the year. In fact, both the S&P 500 and the NASDAQ are in classical overbought conditions. What does that mean? It just simply means they get ahead of themselves. There's an old saying that human beings make lousy investors. And that there's some truth to that, because that's why human beings push the market too far. Last year, they took it down further than it needed to be. And so a little bit of ahead of itself right now. I'm glad to see that today, and maybe because of what Fitch said, probably not, the market's going to in the next couple months, August and September. September, I think historically is the worst month of the year. Doesn't mean that it's that bad, but historically, it's probably time for a pause. But actually, I came into my office today, excited to see the futures down so much, because it was getting harder and harder to make decisions based on the market being so overbought. The S&P 500 got about 11% above its 200-day moving average. The NASDAQ 100, I think, topped about 25% ahead of its 200-day moving average. But let me give you a couple of statistics that I think are interesting. First of all, let's talk about the first half of the year. Historically, 2023 was the 23rd time since 1945 that the S&P 500 was up at least 10% in the first 6 months of the year. Historically, if you have double-digit gains in the first half of the year, The median performance the last half of the year in those 23 times has been 10%. And 82% of the time, the market's been higher. Now, it's interesting. I'll add one caveat to that. The market was down last year.
Sure.
Historically, when the market's down and then the first 6 months of the new year are up 10%, the market averages 12% the balance of the year. So just some historical statistics that, sometimes history doesn't always repeat itself,
Right.
but I think it's important to
Patterns.
point that out.
Yeah. So I have a quick question for you. You mentioned
Sure.
this, you woke up this morning excited to see futures were down, and then you and I off camera were talking and you said market weakness can be a good thing. So speak to that, because that's the opposite of what we hear day in and day out in the media, in financial journals, you name it.
I've never climbed Mount Everest, and I don't think at my age I ever will. But there's points along the way where you get pretty tired and you have to stop, right?
Sure. Yeah.
And you have to camp and you have to rest, whether that's what they call a base camp. I'm not a climber, so I don't know the right jargon there. Well, the market's kind of the same way. The market goes up, 80% of the time historically, but it gets ahead of itself. It gets tired, it gets overbought, and it's got to rest a little bit. Yeah. Without that rest, the climber is not going to be able to go off the next day onto the next leg of their journey up Mount Everest. Well, it's kind of the same way with the market too. It has to pause, refresh. I call it profit taking, backing and filling. By textbook, if that rest is at least a 10% pullback, they call that a correction, which even in the context of a bull market is not unusual. But what that does is kind of like the climber rests for his next day's journey. The market builds a new foundation so that the next leg up the market can be better sustained.
Got it.
That's why if you do much reading, you'll talk about market corrections or pullbacks in the context of a bull market. They talk about that it being healthy, and it is healthy for the market to pull back. Get a little bit of the froth out of it. Sure. Get the easy money out. Put a little fear back in people's hearts. And then it goes on back up from there. Another stat along those lines I wanted to give is talking about the market just being ahead of itself. On July 17th, the NASDAQ 100, that's the 100 biggest NASDAQ stocks, a lot of technology stocks, for example, closed 25% above its 200-day moving average. In the 7 periods where it had been up 25% above its 200-day moving average, 6 or 7 times it went down for the next week or two. Maybe what we're experiencing now. But here's the interesting stat. Over the next year, the NASDAQ was higher all 7 times. You ready for this? With a median gain of 23.5%.
Interesting.
So, market gains kind of beget market gains, if you will.
Sure.
The market being overbought is a good thing. It tells people to engage with the market again. They looking past their current concerns. They think the market is going to do well. But that doesn't mean we don't have to pause every now and then.
Sure.
And rest for the next journey up the mountain.
So really, if I can just the market just the pauses, it's almost like resetting a balance, or the balance in the force for those of our viewers here who like Star Wars. I mean, that's really what it's doing.
Right.
So, all right. Thank you for answering that question. My next one is, and maybe it is more geopolitical, just the news cycle. I don't know, but I had asked you a question before about with the market seems solid and the economy seems strong, specifically the job market. So why are people so nervous? I guess it really doesn't matter. So this next part of my question, why they're nervous, but what do you tell average investors right now who are freaking out?
A great question. I think the biggest thing to do is you have to be positioned right. You have to decide how much risk you want to take with what percentage of your assets. But then once you've done that, you've got to remember that investing is a marathon. It's not a 100-yard dash. I've been in the market since about 1982 or so, going on 42 years, I guess. And I have never sold, whether it was 1987, 2000, 2001, 2022 for that matter, or for that matter, 2020 when we had the COVID.
Sure.
Because my focus is longer term.
Right.
And I think as long as you can put yourself, when we're having trouble in the market, if you can kind of put yourself 6-9 months, a year out in your vision, and just don't worry about it. I used to joke, go play golf, read a book.
Sure.
What do you like to do? Ignore it if you have to. But the problem is a lot of people succumb to human emotions.
Sure.
And the fact is, you just have to remember that it is a marathon, not a race. The fact is, the market historically goes up 80% of the time. But that means sometimes it goes down as well, right?
Sure. Yeah.
It's funny when, it's a psychological thing called the recency effect. If it's going up, then it's going to keep going up, right?
Right.
And I've always joked that when the market's in a strong bull market, people even forget that it can go down, which I think causes even more frustration and emotion when it does happen.
Sure.
Just know that's normal. It's an ebb and flow. And if you have a longer term time horizon, remember to focus on the long term. I would suggest that every bear market in my career, and the proof is in the pudding, right? I think I when I first started in this business is when the Dow Jones first went through 1,300. Okay, now it's 33,000 or something.
Sure.
The fact is, if I would have taken every bear market in my career as an opportunity, I'd probably be even better off than I am today. So look at it as an opportunity, not a reason to panic. The market always comes back. It goes up 80% of the time. Now, that said, if you have money that's targeted for something you want to buy 6 months to a year from now, then maybe it shouldn't be in the market. If you're nearing retirement, you're going to turn your savings into an income vehicle, and you're near retirement, then maybe you shouldn't have all your money in the market. But so that's what I meant by gauging, your risk tolerance and the amount of exposure you should have. But remember, the market is ownership. When you put money in the bank, you buy a CD or a treasury bill or a bond, you're a lender. And most people know just from home ownership, if nothing else, owners get rich. Lenders are just getting interest and hoping they get their money back.
Sure.
Ownership is always worth more over a longer period of time than being a lender. So I would just encourage people to think longer term, and
know their risk tolerance. I mean, you've said that a few times, and I think that's critical, being really honest with yourself about how much you're willing to be risk you're exposed to.
Right. For example, maybe you're okay being down 10% if you know over time you're going to be up 15, or maybe I'm okay being down 20 if I know I'm going to be up 30 over time, or I'm okay being down 30% if I know I'm going to be up 50% over time. And I just pulled those numbers out of my hat. So, but it's a good way to kind of judge who you are. And remember, emotions sneak up on you, and you just kind of have to make sure during times of market turbulence or concern that you're, to the extent that you can, thinking with your head, not your heart. And if you question that at all, actually, the best thing to do during times like that is really good advice, though it's not advice at all in one way. You know what that is, Michelle?
What?
Do nothing.
Do it. Just read a book.
Just
walk away.
Play golf. Exactly.
Yeah. All right. This has been really fascinating conversation. Is there any question I've asked about just what's going on now that I should have asked?
Well, only one thing I'll mention, and that is I do think we're in a new industrial revolution, if you will.
Talk about that.
Let's talk about the internet.
AI.
The internet in the late 90s, or in the late 90s, early 2000s, there was only a handful of people that are even on the internet. Now, billions of people are on the internet.
They
There were
all have an
companies,
opinion.
yeah, there were companies that did well back then. There were companies that didn't do well back then. But it was a revolution. The same thing's happening now with AI. And I would just encourage people that I think that's a real positive. AI will not only make companies more efficient,
Sure.
and if companies are more efficient, what happens to their earnings? Their earnings go up.
Yeah.
If the earnings go up, what happens to the price of the stock? At the
Goes
same
up.
price earnings ratio, the stock goes up. So I think it's going to be very healthy for the market over time. But you have to be very careful during these times. You don't buy a stock just because they're into AI, because there will be kind of like biotechnology, early biotechnology.
Sure.
There could be 50 losers for the one that is the grand slam. But I will say that if you stay with the bigger names that are tied to AI and think longer term, I do think artificial intelligence is our next industrial revolution that could propel the market a lot higher over time. And yet, it's the same thing that can cause short-term overbought conditions,
Right.
and short-term bubbles that have to unwind. So there's an old saying that if the market runs too much because of AI, there's an old saying that the way you make money in the market is to be a nice person. If you think that if the market's gone way up, say fine, you can have some of mine. And during a time of market turbulence, when nobody wants it, you say, well, okay, I'll take some, and you'll win over time. But no, I think the industrial revolution, if you will, of AI is going to cause some volatile periods in the market.
Sure.
Because
A lot of disruption.
yeah, it'll get ahead of itself at times and have to back and fill. But the fact is, I think it's from an economic and more so market standpoint, I think it's going to go bode well over the next 5 or 10 years.
Okay, great. All right. Well, that's about our interview. It wraps up our interview. If you would like to find out how you can get some help with your 401k, check out 401kmaneuver.com. Just go read all about it there. And Mark, I really, really appreciate this. Thank you so much. This has been calm in the midst of a storm. Feels.
Perfect.
So thank you.
Great conversation. Thanks, Michelle. Bye now.
All right. Bye-bye.